preparing the balance sheet and the income statement based on a small caselet, A and B part of it, Lone Pine Cafe, which you can see on the screen. So, we worked on preparing the balance sheet and we prepared two kinds of balance sheet. One was when the cafe was started, we prepared a balance sheet. The next one, when the cafe basically shut down operations on 30th of March, we prepared a balance sheet out there. We compared both the balance sheets out. When we prepared this balance sheet, I talked to you about the sources of funds, this part of it, sources of funds out here and the utilization of funds out here. That is what I have also written out. That is, what are the sources or the utilization. We arrived at if the sources of fund is more than the utilization, that is, you have made an inefficient utilization of the fund, that leads to basically what you call it as a loss now out here, and that is what we could see in this particular case. And we said there are two balance sheets, opening, closing. One balance sheet on a specific date, on a specific day, and during the period how did the organization or the entity or the cafe perform. We prepared what is called as the income and expenditure statement for the period out there. We took all the revenues, we took all the expenditures that have accrued, and we said we found out that the cafe had incurred a loss, which was basically matching with what we had calculated in the closing balance sheet out. And I have given all the workings also of when I was doing the income statement or profit and loss statement. I had given basically many of the workings out there, I had basically shown it out. Now, from there we move to the next possible financial statement out. When I say what is the next financial statement? The cash flow statement. The cash flow statement tracks the movement of cash, as I had indicated in one of the initial classes, I think the first class or so. It is a third financial statement which indicates only the movement of cash, whereas the income statement indicated what is the income accrued and what is the expenditure that have accrued, whereas when we talk about the cash flow statement will talk about only the money coming in and money going out. Now, to give a little more explanation on the cash flow statement out there, to give a little more explanation on the cash flow statement out there, let us see what is a cash flow statement. In a cash flow statement, we will classify the cash flows into three basic categories. First category being cash flow arising because of operations. The second statement we will say cash flow arriving due to what is called as investing activities. The third, when we will say cash flow arising due to financing activities. Now, what do you mean by all these three? What do you mean by financing? What do you mean by investing? What do you mean by core operations out? When I say I am talking about the core operations part of it, the cash that basically it comes in or goes out due to the core activity of the business, the cash that comes in or goes out. For example, I pay my suppliers. When I pay my suppliers, there is cash going out of my company. I receive money on the sales that I made, cash coming in to the company. I pay wages to my employees, cash going out of my company because of core operations. I pay salaries to my staff, cash going out because of what do you call it as the salaries for the core activity, because of the core activity out of my company, cash going out because of my operations out there. So, it deals only with the cash inflow and cash outflow from the core activity. In this particular case, I said the core activity is what we call it as the operations out there. The next aspect I am going to move to what is called as, we look at what is called as cash flow from investing activity. When I talk about investing activity, that is, it tracks movement of money, it tracks movement of basically the cash out there related to any investments. Now, what do you mean by investments? I buy a machinery. When I buy a machinery, what is happening? Cash, and I buy a machinery and cash. Cash going out of the company related to my investment activity. Why? I've invested money in the business out there. I pay my EMI for the machinery that I have purchased. Cash getting out of my business due to an investment related activity. I sell my old machinery, I receive money. You sell it for profit loss, I don't care, but you sell the machinery, you receive cash. Cash coming in, that is cash coming in out there, be related to what do you call it as my investing activity. Sorry. Cash coming in related to my investing activity. So, when money comes in or goes out related to investment, again I can extend it further. I invest money in a subsidiary, I buy equity shares of the subsidiary company. Cash outflow because of an investing activity. I invest in an affiliate company, I invest in a joint venture, I invest in a government bond, I invest in a liquid mutual fund. All these things, cash outflow because of an investing activity. I sell the bond, I receive money, cash inflow because of an investing activity. I sell the liquid mutual fund, money comes in, cash inflow because of an investing activity. The subsidiary in which I have invested cash, I have invested equity or whatever, is giving what is called as dividends. Now, I am receiving the dividend, cash inflow that is coming to me because of what activity? Because I have invested, cash inflow because of an investing activity. I receive money, when I say I receive money on the some kind of an investment I have made, I simply have a fixed deposit in a bank. The deposit matures, the money comes back to me, cash inflow because of an investing. Interest, yes, cash inflow because of investing. I am not worried about profit or loss here. I am worried about cash coming in and cash going out, and that is what when we say investing activity. The third basic aspect what we talk about out here in this particular case is what we call it as the financing activity. Sources of money for financing, I said for sources of money. I issue equity shares, money cash inflow because of a financing activity. I borrow money from a bank, cash inflow because of a financing activity. I repay the loan that I have taken, cash outflow because of a financing activity. I pay interest on the loan, cash outflow because of a financing activity. I pay dividends to the equity shareholders, cash outflow because of a financing activity. So, financing activity means anybody basically, that is, it tracks money movement related to financing the venture. It relates to money movement related to financing the venture. So, these are the three basic classifications out there. Now, why do you need these three classifications? I need to know what is the cash inflow and outflow coming because of my core activity, that is operations. I need to know what is the cash inflow or outflow coming in because of the investing activity. I need to know for cash inflow or outflow because of financing activity. Your company might have a lot of cash in the cash box. Doesn't mean everything has come from operations. It might be because of financing, you might have borrowed money. So, because of that, you might have piles and piles and piles of cash out there. Doesn't make the company great. So, you need to know where from the money is coming in and where from the money is investing. Let me take an example. Imagine you're a mature enterprise. You are not augmenting any capacity or anything in the company. You are not going for expansion. You are only repaying the existing loan what you have, as well as servicing the loan what you have, and equity, servicing of equity and loan what you have. That's all. You are not making any major investments out there, just replacement here and there. So then what happens? Your operating cash flow should be so big that it takes care of any replacement of machinery that is required out here, that is investing out here, the negative cash flows out there, that the positive cash flow here should take care of any negative cash flow here, as well as servicing the financing activities out there, that is repayment of interest, etc., 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 out there, servicing it out there. So the positive cash flows from an operations will take care of any investments that you may have to make, as well as will take care of servicing the financing, the servicing the debt what you have out there. So ideally what happens? Ideally, let me quote that. The operating cash flows is so positive that you have excess money, excess cash, you pay for all your interest, that is negative cash flow, that is your financing cash is only a cash outflow, net outflow. Your investing part of it, you invest again a net outflow, but all these is covered by your operations out there, which has significant positive cash flow. Supposing, take a situation, you are purchasing a new machine, making a new, augmenting a capacity by raising funds from the market out there, by raising a debt in the market. Then what happens? Operating cash flows are positive, could be positive. Your investing cash flows will be negative because you are investing cash outflow, but your financing cash flow is also positive because you are borrowing, that will also be there. So you look at, in this particular case, where from the money is coming in. The money is coming in because of what activity, and money is getting out because of what activity, and that is all what we do. Now having said this, let me go back to the Lone Pine Cafe out there. Let me go back to the Lone Pine Cafe in this particular case out there, and let us prepare a cash flow statement for Lone Pine Cafe out there. Let us try and see if we can prepare a cash flow statement for Lone Pine Cafe. Now, I have started my business with some cash in hand, that is on November 2nd out there. I started with some money in hand out there. When I say cash, we mean to say, that is one more thing I need to stress on. When we say cash out there, we mean basically what happens is we normally say cash and cash equivalents. What do you mean by cash and cash equivalents? It might be liquid cash, it might be money in the bank account, it might be marketable securities, all these three put together. These are all what we call it typically are cash and cash equivalents. So when we say cash flow, we are taking all these three together. We are taking all these three things together out there. Please note. Now let me go back to my Excel sheet out here. We see that on November 2nd, the cafe had a cash balance of 10,172. So let us sort of do that out there. The cafe had a cash balance of about 10,172. So let me say that I just have to get my keyboard. Let me say that is the opening balance of cash. Is 10,172. Now let me do cash flow from operations. Cash flow from operations. Now this is the cash balance with which you began your operations. Now, I want to see what is the operations cash flow, what is the cash flow that the operations activities are generated. I want to see what is the cash flow that the financing activity is generated. I want to see what is the cash flow that the investing activities have generated. Now, if I club all these four, then the cash what you will have will be equal to your cash balance at the end of the month, end of the period out there. Now, let us do this and I will explain little more out there. Now, I am going to Loan Pen Cafe B. Loan Pen Cafe B says cash received from customers amounted to 43,480. Cash received from customers, that is cash inflow, cash received from customers is 43,480 inflow. Monthly payments to partners, what is that? It's again, why are you paying? You are paying them as a salary. Salary is what? Operations out there. Monthly payments to partners is about 23,150 cash outflow, money going out 23,150. So, I have put a negative sign there, cash outflow. Next, wages to part-time employees I paid. Is again a cash outflow 5,480 cash outflow, money getting out of the company out there, cash outflow, these are cash outflow. I am still looking at food and B is 10,016. Sir, the food and B consumed, if you when you did the income statement, you said it is 11,969. You did a lot of calculations here, etc. Please note the difference. In an income statement, we carry as an expenditure what is accrued, what is consumed during the period is accounted as an expenditure. In a cash flow statement, I am not worried about what you consume. I am worried about what is the cash that has gone out for that activity. The cash that has gone out at the activity in as far as F&B is concerned is 10016. That is all the money that has gone out there. That is all the money that has gone out there, and that is all what I will consider. I am not bothered about how much accrued, how much consumed, how much is still in stock, how much is not in stock. None of it I am worried, because I am worried about what am I tracking? Money going out, money coming out. Next, telephone and electricity. Telephone and electricity is 3270. Why am I putting minus? Because it is all cash outflow out there. Miscellaneous is again cash outflow of 255, and then the last one being rent payment out there. That is also a cash outflow in this case. Now, I need to know what is the money that the operating activity has generated. What is the money that the operating activity is generated? Let me say cash flow from operation. Cash flow from operations out there, it is nothing but I would say at sum. This is the inflow, rest all is outflow. This is what is the cash that the operations have generated. We see that the operations have generated minus negative $6191. We see that the operations have generated negative $6191 out there. We see that the operations have generated negative $6191 out there, and unfortunately what is happening is this is the cash that basically is getting generated from operations. Now, I am talking about the next one out here, that is cash flow from investing activities. Investing means where I have invested money between November 2nd and November 2nd and March 30th. I do not see there is any inflow or outflow that has happened because of an investing activity in this case out. There is no money that you have invested in a machinery, in purchase of an asset, There is no money that you have sort of invested in any other what you call deposits or anything out there. Unfortunately, the cash flow from investing activity in this case is nil out there. So, let me go further. I will say cash flow from financing activity. If I look at cash flow from financing activity out there, I have paid interest. You see that I have paid interest. So, what is the interest that you have paid? Negative 540. Cash has gone out. Cash has gone out to the extent of $540. Next, if you look at the opening balance sheet out here, initially the borrowings was 21,000. What has happened? If you actually see this out here, the borrowings have become 18,900. So, from 21,000 to 18,900. That means what? The statement also says, if you look at Lone Pine Cafe A part of it, it also talks about the partnership has been able to repay $2,100 out of. I'm just figuring out. Yeah, last line out here. The partnership had also repaid 2,100 of the bank loan. When you repay, what happens? Cash gets out of the company. That is repayment of loan. How much is the repaid? 2,100 is what is repaid. That is a cash outflow. There is no inflow. There is no inflow. So, cash flow. So, in this particular case, cash flow from financing activity is how much? It is again at sum between this and this. So, what happened? You started with $10,172 cash. Your operations have generated a negative cash of 6,191. And what do you call it as, your investing has not generated even a dollar of cash, either positive or negative, and your financing activity has generated negative cash flow of 2,600. So, what happened? I began my operations with this. This is what is generated, this is what is generated. The sum of all these should give me what? Should give me what is the cash balance at the end of the period out there. Let us take a simple example. You start from your house with $100 in your pocket. You go to the ATM, you borrow $1,000, you withdraw $1,000. Then you go out to a cafe, spend about $200. You go to a shopping, purchase something for about $300. Then you go out somewhere else, you purchase you spend another $150. Now, how do I know what is the money that should be there in the pocket? I started with 100, added 1,000, so totally my cash was 1,100. I spent 200 on coffee, that means comes to 800. I spent 300 on some clothing, so 500. I spent another 150 on something else, so 500 minus 150, 350. So 350 should be the cash what you should have at the end of the day in your wallet out there, right? So exactly similar. Let us just do what we do. We sum this out there. I just have to sum this out there. If I sum this out here, okay, it is not totaling properly. Okay, fine, because these cells are not coded properly, no problem. So, basically 10,172 is what I started off with. I added this 6,191 and then I add this 2,640, that is cash flow from financing. What should it lead to? It should lead to the cash that should be there at the end of the day, cash and cash equivalents. At the end of the period. Cash and cash equivalent at the end of the period out there. Sir, if you look at your cash balance, it says the case says the cash balance is only $311, but you got a different figure of 1341. No problem. The cash was $311. Now, let me go to what was the balance in the bank account out there, and it says the checking account balance was $1030. That means 1030 plus 1311 is $1341, exactly what we have. That is equal to, you can from the case you can see cash, what you had is in this case was 311, and then bank or slash checking account, what you had is 1030, and the total of this is 1341. You can actually see it matches out here in this particular case out there. It matches out, right? So, what did you do? Again, I took the same example. You start with $100 in your pocket, go to the ATM, take $1000, spend something in a cafe, $200, buy clothing, $300, spend on some entertainment, $150. Again, you go to the ATM, take $500. Then you go and spend something on $300, and then you come back. How much is the money left? We just track it. Start with 100, added 1000, minus the 200 what you spent for a cafe. So, it means 1100 minus 200, 900. You spent 300 on the clothing, 900 minus 300 is 600. You spent 150 on something, so 600 minus 150, 450. Then you added a 500 you took from the ATM, so 450 plus 500, 950. Then you spent something whatever 300 or something some number I gave 300 out there. So, what happens? 950 minus 300, 650. 650 should be there in your balance account. That is all what we have done. We said this is the cash with which you began operations. This is what your operations has generated. This is what your investing has generated, and this is what your financing has generated. So, what is the cash you should have? This is the cash what I should have, and that is how I verify. And this is what we call it as a cash flow statement out there. So, what have we done with the Lone Pine Cafe? We started preparing a balance sheet when the entity was started. We prepared a balance sheet when the entity folded up or wound up. We prepared what is called as the income and expenditure statement out there, and we also prepared the cash flow statement out there in the process. So, we have prepared all these statements and we have learned all these statements out there. Now, to reinforce your learning, what I am going to do is, I am going to do one more case again from the same prescribed textbook. The case is titled as Maynard Company A and Maynard Company B. Maynard Company A in chapter 2 and Maynard Company B in chapter 3. I am going to solve that case. What is that case on? Preparing a balance sheet and an income statement. We are going to prepare a balance sheet and income statement based on the Maynard Company Cafe case, and then let us see if we can, how we can take it forward from there out there, because that will give you a better understanding of the balance sheet and the income statement.